All right. Today is Thursday, March 25th, and this is a recap for the stock market activities today. We are still guided by three factors: the virus infections, oil prices, inflation expectations, and Treasury yields. The market is still processing on which direction it wants to take, processing all the information day by day regarding these three factors. We are aware that the rate of infections continues to increase rapidly, not just in Europe, but even here in the US. We are seeing some states registering more infections. On the other hand, the situation over at the Suez Canal still acting as a counterforce for the rise in infections, because when we see the lockdowns prolonged, that will dampen inflation expectations and thus pushing Treasury yields lower. Meanwhile, the rise in commodity prices, the shortages of supply, and now the situation over at the Suez Canal is helping inflation expectations rise higher. So you have this tug of war going every day right now, and the market is processing all of this news. It hasn't made a decision yet, but I use the movement in the bonds market as the indicator. Today we saw yields rising slightly higher, and right away you saw that the inflationary trade is outperforming. Meanwhile, in this state of confusion and indecision by the market, it still has a foot in each route, meaning in yesterday's session we saw everything getting dumped by the end of the day. The Dow Jones, the Nasdaq, the IWM, the S&P 500, and today we saw everything rallying together by the end of the day. Even though the inflationary trade, the Dow Jones, is outperforming the deflationary trade of technology and high growth. Yesterday we saw yields diving lower. Today we saw them stabilizing higher once again. And this is what's confusing the market. It's not making a decision because of the action in the bonds market. The bonds market has to process the news about the virus and the news regarding inflation. And we know by the end of the day that the Federal Reserve will dictate which route the market will take. And that will happen once the market interprets their decisions or lack thereof in addressing the rise in Treasury yields, because for all we know right now, the Federal Reserve is not spooked by the rise of Treasury yield as the stock market is, meaning that the Federal Reserve is saying our pain tolerance is a lot higher than what the market expects. So the rational conclusion here is, if we don't have a black swan event, and if we continue to see the rise of inflation going on, then yields will start resume the rally higher. Once that happens, the Nasdaq will start to plummet once again, and the inflationary trade will see another leg higher. And this is, of course, based on the current stance by the Federal Reserve. I do have updates for you from the Federal Reserve personalities and the statements that they're issuing, and we're trying to dissect where the weakness resides. We heard from Kaplan. Kaplan believes that interest rates will rise higher sooner than the consensus of the Federal Reserve. The other thing that took place in the market today is the testimony by tech executives, the CEO of the largest social media platforms in Washington, D.C. And of course, it is a circus as expected. We're not going to comment on it because there is no value whatsoever in doing these hearings. And all what you need to know about that is the following. Congressman, what about YouTube? And of course, he addressed the question to Mark Zuckerberg, who is the CEO of Facebook, not Google. And Zuckerberg responded by saying, "You're asking me about YouTube?" And the congressman says, yes. So here are your beloved politicians. They are absolute brain-dead zombies. We will continue the discussion during the headlines of the day segment. But for now, I got a market to cover. And here we go. The Dow Industrial Average closing in the green by 199.42 points, or a gain of 0.62%. The Nasdaq closing in the green by 15.79 points, or a gain of 0.12%. The S&P 500 also closing in the green by 20.38 points, or a gain of 0.52%. And here are the sector's performances for the day. Leading the pack at number 1, capturing the gold medal, industrials at number 2 for the silver, real estate at number 3 for the bronze, financials. Meanwhile, the laggards of the day led by communication services, energy, and technology. So all in all, the inflationary trade is outperforming today with exception of energy because energy prices are down today when we talk about crude oil, even though the situation over at the Suez Canal remains the same. The jam log continues to grow and grow and grow. So the rational conclusion here is that if the situation continues for a few more days, oil prices should be jumping higher. But you have to remember, oil prices also have headwinds from the rising virus cases over the EU and the information we got regarding inventory here in the US. Moving on to the futures market performance, and let's see what's going on here. Crude oil diving lower, losses exceeding 4% for both the WTI and the Brent. What about softs futures? Lumber, one of the main components of the axis of inflation, rising higher today by the tune of 3% for the futures. We also saw gains for cocoa and coffee, while the losses were in cotton, sugar, and OJ futures. Cotton down almost 5%, meanwhile sugar down over 3.5%. OJ a little below half a percentage point. What about metals futures? Red picture across the board, and the losses led by platinum, copper, palladium, gold, and silver. Of course, we are aware that the dollar index rallied again today, and when the dollar rises higher, metals futures don't like that. They like a lower dollar. Shifting to meats futures, what's going on here? The rally in lean hogs futures continues to explode higher, and now we have lean hogs futures reading over 100. So that also adds to inflation, and the reason why we're seeing lean hogs futures rallying higher is the African swine fever over in China. But we also saw gains for feeder cattle futures rising by about 1%. Meanwhile, live cattle futures closing with about 0.4% gains. And what about grains? Grains don't like it when the dollar rallies higher, and we saw losses across the board led by soybean oil down over 4%, and then we have wheat, rough rice, canola, corn, and soybeans futures reading lower. Meanwhile, the lone gainer in grains futures, we have soybean meal futures closing in the green by about 1% or so. Moving on to the big casino, the options market. Let's see what's going on here. Is the stimmy money starting to show up? That is the mystery, because we saw meme stocks outperforming today, led by GameStop rising over 50% today alone. So is there something here? Are we starting to see the stimmy money showing up? Let's see. At number 1, Apple. With about 1.25 million contracts traded today, about 66% of those were calls. Number 2, AMC, with about 650,000 contracts, about 64% of those were calls. Then at number 3, we have Tesla, with a little over 600,000 contracts, about 48% of those were calls. And then we have Palantir, Neo, GameStop, all with slightly elevated options volume. But we're not seeing traders buying calls decisively, meaning that perhaps a tiny portion of stimmy money is starting to show up by chasing these mania names. But some of them are using the money to also bid against these names, and therefore you're seeing a freak show in the market. You see these meme stocks rallying higher today, GameStop stock over 50%, and you're asking yourself, should I participate here, buy calls? Should I short by buying puts? What do I do here? You do nothing. You grab a big bag of popcorn and you watch the freak show. And what about the unusual trades that took place in the market today? Starting with the ticker INTC for Intel. We talked about Intel building their own factories here in Arizona during last video, but the market is not appreciative of that news, and they actually traded Intel stock lower. But somebody is betting that after the processing is done, the market will realize that this is a very good move by Intel, and they are buying The 66 calls expiration date April 30th, with expectations that Intel will gain over 6.5% by then. They paid about $1.35 apiece to enter this trade, bringing the total all the way to $3 million. And what about the trade for the ticker BIDU? Baidu. This is a wild chart because it has 1 day before expiration, meaning it expires tomorrow. Somebody's buying the 220 calls expiring tomorrow with expectations that Baidu will rise over 7.5% by then. And they were willing to pay $1.25 apiece to enter this trade, which brought the total all the way to $1 million. So $1 million on the line tomorrow. Is this a casino or what? What about the ticker TAN for TAN? This is the solar ETF. We saw a lot of pain in solar because all of that mania trade from last year, it's fading right now. We saw significant losses for TAN, and somebody's betting for more losses to come by buying the 79 puts expiration date April 1st, with the expectations that TAN will drop over 7% by then. They paid about $1 apiece to enter this trade, which brought the total all the way to about $750,000. And what about the trade for the ticker CFX? This is for Colfax, and they are making a bearish bet by buying the 42.5 puts expiration date April 16th. With expectations that the name will drop over 6% by then. They paid about 90 cents apiece to enter this trade, bringing the total all the way to $700,000. And what about the trade for the ticker XOP? This is the oil ETF. I like this one better than the XLE, by the way. And somebody's betting for a rebound here in oil prices. You know, we got the ship and everything stuck over the Suez Canal, so rationally, oil prices will jump higher. And we all know that the ship did not get stuck coincidentally, right? Should we talk about that, or are we gonna get banned? Anyways, the purpose of getting the ship stuck over there is to bid oil prices higher. So why fight it? And here we have somebody buying calls, making a bullish bet that oil prices will resume rallying higher by buying the 87 calls expiration date April 16th. With expectations that the XOP will gain over 7.5% by then. They paid about $1.75 apiece to enter this trade, which brought the total all the way to $1 million. And lastly, what about this trade for the ticker LRCX for Lam Research? We talked about Lam, AMAT, ASML as the bullet stocks for the semiconductor shortage wars. And somebody's making a bullish bid here on Lam Research by buying the 625 calls expiration date April 16th, with expectations that Lam will gain over 10% by then. And they paid about $3.80 apiece to enter this trade, which brought the total all the way to $2 million. Moving on to the headlines that shape the day, starting with macro news. What else? The situation over at the Suez Canal and the monster ship that is still stuck over there. And as of for now, the market did not take this story seriously. We actually saw oil prices dumping lower. But again, at some point, the market will have to process this piece of news, that it is a factor adding to more inflation expectations and more upward pressure for oil prices, because it doesn't look like they will unclog the jam anytime soon. Of course, when oil prices pop higher, then magically the ship will get unstuck. But for now, the log jam is building up by the day. We have shipment delays adding up, matter of fact, to the tune of $400 million an hour worth of goods is being stuck over there. So once again, if you thought that the issues over the supply chain are already alarming, watch out, because here is more. And now shippers are actually taking the longer route, the old school route, when you have to go through Africa before the Suez Canal got built. But that will take more time, more fuel, and it will add to the price, meaning that inflation expectations will pop higher once again. We have a problem already with shipping containers and the delays in shipping. Now we're just adding more gasoline to the fire. And here is the sheer size of this ship, almost as big as the Empire State Building, and it's stuck over there, and that's not going to be solved by paying a couple of guys $20 to shovel it out of the snow. And all of that is adding to higher inflation expectations, because the American Petroleum Institute, they met with the Joe Biden administration. We have more meetings planned with oil executives, but they are surrendering already, and they're saying, all right, we know that this administration will be anti-oil and more aggressive in implementing the ESG initiatives. So the oil lobby is already waving the white flag, but they have one trick up their sleeves. They're actually endorsing carbon pricing and taxations by mandating limits on emissions and paying penalties and taxations for exceeding those limits. But the oil industry doesn't want to be the lone victim in that game. And they are trying to lobby the administration to impose the same limits on every single business, not just the oil industry, but every business, every sector in the economy has to obey these emission limits and penalties. And the oil lobby knows that at the end of the day, they will pass all of that extra cost to the end customer, because they will face more taxes and more costs to curb emissions, and all of that will be passed to the end customer, and thus inflation expectations rising higher. Because what the oil lobby wants is higher expectations of inflation and energy prices, and those expectations alone could drive oil prices higher. So knowing that we are going to have more regulations on oil is not going to push oil stocks and energy prices lower. It will actually push them higher due to inflation expectations. And speaking of inflation expectations, here is a survey for American households, asking them, how concerned are you right now about inflation in the United States? They surveyed about 2,500 adults, and as you can see, Americans are worried overwhelmingly about the rise in inflation. Those who are aged between 18 and 24, 52% say that they are very worried about the rise in inflation, and 50% of those between 25 and 34 say the same thing. Likewise, 48% between 35 and 54 also believe that inflation is very concerning. Meanwhile, for those who are above 55 years of age, about 37% of those say that it is very concerning. Of course, they've been through the 70s great stagflation, so bring it on, bitch. They're not as concerned as the younger generations are. But all in all, when you add 37% who say it is very concerning and 44% who say it is somewhat concerning, you get the majority of people, even over 55 years of age, saying that the rise in inflation is very concerning. And here is what the deflationary crowd doesn't get. They don't get the fact that inflation could take place based on the psychology alone. If we start to expect more inflation, that will actually drive inflation higher, meaning that whether we had any inflation actually coming or not, our expectations of the arrival of that inflation caused the inflation. It works as a self-fulfilling prophecy. But the fact is that inflation expectations are not just rising based on the psychology alone. We do have actual facts and events supporting higher inflation. Here is from the Wall Street Journal. Hot U.S. economy, fresh supply disruptions pressure world's factories. The strongest U.S. expansion in 30 years is making for long delivery delays and price increases, exacerbated by Suez disruption, factory fires. So we do have a legitimate shortage in certain commodities, and we have supply chain disruptions, whether it is the Suez Canal or fires, that are making that leap for supply to catch up with demand a lot longer. U.S. executives have reported the most severe supply disruptions since 2007. There are some signs that those shortages are modestly slowing growth, but that doesn't mean that the pinned-up demand is going to go anywhere. It's still here because it is fueled by the main source of this inflation problem, the cocaine operation, the money liquidity, the printing funny money out of thin air. That is the root of the problem. More data regarding inflation. What's going on with metals prices? Let's talk about platinum. Platinum jumps on inflation concerns, propelled by broader rally. The precious metal is trading at the highest level in 6 years. Prices have more than doubled since hitting a low last March, and therefore I am bullish on South Africa specifically the mining industry in South Africa, and I am investing in these South African miners. But I know the deflationary crowd has their blindfolds on, they still got their TLT calls, and they are praying for the Lord for some mercy, or shall we say bad news? Because the only ally they got, we're talking about the deflationary crowd and NASDAQ bulls, by the way. The only ally they got is bad news, specifically regarding COVID. If we see COVID cases rising higher, all these bonds and NASDAQ bulls will have a massive orgasm. And they are cheering, of course, COVID, 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 because that's your only ally. In the era of good news is bad news. What are we talking about here? We got the report, the weekly jobless claims, and they came better than expected. U.S. jobless claims reached the lowest level of the pandemic. Claims fell to 684,000 last week, adding to evidence that the economy is ramping up. Now, an economy that is still registering about 700,000 claims of unemployment every single week is not a healthy economy. And this is not good news, but it is good news if you are following the trend, because this week we dipped lower, registering the least amount of weekly unemployment claims since the beginning of the pandemic. And right away you saw yields rising higher due to more inflation expectations, because it is the tug of war, remember, between good news and bad news. COVID cases rising higher, that pushes inflation expectations lower, and the market rises higher, because the market likes bad news right now, because bad news mean less inflation. Meanwhile, good news, beating the virus, inching closer to reopening, that's good news, right? It is good news for the economy, but it's not good for the stock market because it pushes inflation expectations, oil prices, copper prices, platinum prices, you get it, higher and higher. Once again, we are between the tug of war between good and bad news. Good news benefit the cyclicals, the Dow Jones, industrials, materials, banks, energy names, the reopening trade. Meanwhile, bad news benefit technology, growth, high-value names, the stay-at-home names. These are the dynamics that are going on in the market right now anyways. But okay, for all of you bond and NASDAQ bulls, you did not get some bad news in the morning today because jobless claims came better than expected. So what do you do now? You pray for the Lord that the propaganda from the Federal Reserve will have a psychological impact in the market and it will be effective in pushing rates and yields down. We know it's been going on for weeks with no luck whatsoever, but perhaps if you pray a little harder, yields will go lower and they will believe the Federal Reserve because they are continuing to hammer on the same narrative and the same tune. Powell praises economic recovery and sees Fed pulling back help after quote-unquote substantial progress. So Mr. Powell is saying, relax, I got the cocaine operation and low interest rates going on until I see quote-unquote substantial progress. And by substantial, he means we're going to keep it forever. We're not going to take our foot off the pedal until the disaster already happened and Treasury yields are out of control, and then we will decide to do something about it. A reactive Federal Reserve, not a proactive one, which is a recipe for disaster. But notice that Papa Jerome is not saying anything about yields, because if he wants to continue the cocaine operation and he wants to continue keeping interest rates as low as possible for the foreseeable future, and he's not thinking about anything, that will continue to push inflation expectations higher and higher, and therefore yields will continue to rise higher and higher. So perhaps, after all, for all of you NASDAQ and bond bulls, Papa Jerome is not your friend. He's actually your enemy. Remember the rule of don't fight the Fed? Well, the Fed is saying, hey, let yields rise higher. Who cares? Because yields are rising for quote-unquote the good reasons. And market, you shouldn't be worried about the rise of Treasury yields, because yields are rising for the good reasons, and even if they are not rising for the good reasons, and there is inflation, inflation will be transitory. And if it is not transitory, we got the tools, bro. So market, you shouldn't panic here. You should continue to go higher, because we're going to keep the cocaine operation. We're not going to back off the cocaine operation, and we're not going to raise interest rates forever. So why are you worried over here? The market is saying we are worried because what you're doing will exactly push inflation expectations higher and higher and higher, and yields will get out of control. So we don't want to wait until your generous tools, quote unquote, because right now, Mr. Jerome Powell and the Federal Reserve, you guys are becoming a reactive Fed. So we, the market, have to do the proactive role on our own. We have to gather the information, ask the questions, and if we see the disaster happening in the near future with yields going out of control, then we're going to start making the move right now by selling the NASDAQ and dumping bonds. You know why? Because the market doesn't trust the clowns over at the Federal Reserve. Here is Vice Chair Clarida, who's saying that 1.9 trillion stimulus package won't cause long-term inflation. Then we have Clown Barkin. We'll see inflation spike this year, but it will return to normal in 2022. Why do I say that? Because if inflation rises higher, I will bark at it. So rest assured and put your blindfold on and continue to buy. And here we have Boystick. The clowns over the Federal Reserve worked overtime today. Boystick says U.S. unlikely to be staring down an inflation outbreak. Oh, really? And here we have Evans. And Evans kind of slipped a little, just like Kaplan did a few days ago. Evans, rise in long-term rates is a sign of a stronger economy. Okay, that's no different. Rates are rising for quote-unquote the good reasons. This is the Federal Reserve propaganda playbook, but here's the problem. Here is the slipping from Evans. Should be comfortable with 2.5% inflation for a year. Wait a minute here, Mr. Evans. Are you acknowledging inflation? Are you saying we should be comfortable with 2.5 for a year? Because when you people say 2.5, it actually means 5%. And when you say for a year, it actually means for 2 years. So watch out because Evans is starting to slip here and tell the truth just a little bit. Fed's Evans, it is extraordinary that the 10-year rates are as low as they are right now with all the fiscal spending. Wait a minute here. Bartender, cut him off. Cut him off. Before he starts embarrassing the Federal Reserve. He's getting out of the propaganda playbook because what Evans is saying right now is very inflationary. He's saying, I am surprised the rates are not even higher with all of the fiscal spending we're doing. So, Mr. Evans, are you saying that all of the cocaine we hit the economy with is actually going to show up in inflation, and that inflation is not going to be transitory and yields should actually be higher? Is that what you're saying, Mr. Evans? And all of a sudden, Mr. Evans realized that he slipped and he's like, whoa, but wait. But we're not going to raise interest rates until 2024. If Jerome says 2023, I'm going 2024. How'd you like it now? I'm sorry, Mr. Evans, but that's not insurance. Meaning that the Federal Reserve is saying, don't worry about inflation. Don't worry about the rise in inflation rates. Put your blindfold on, come over here and sit down at the blackjack table. And the dealer is showing an ace. You got your blindfold on, and I'm asking you to double down. Don't worry about it. Don't worry about it. He has an ace, but we got the tools for that, bro. What do you mean? You got insurance? No, I don't have insurance. I'm just asking you to double down. And then if it doesn't work, I'll show you my tools. Well, that's not insurance. And telling us that interest rates are going to be low all the way to 2024, that's not insurance. Because if you're actually going to do that and not raise rates until 2024, all of what you're going to achieve is hyperinflation. You donkey. And you know, lots of questions are being raised regarding all of this printing and borrowing. 1.9 trillion. Now we're asking for 3 trillion, 5 trillion, 9 trillion. Aren't you concerned about the national debt? Well, Papa Jerome says the government is more worried about the economic recovery than its debt. And he went on to say, now is not the time to focus on reducing federal debt. Yeah, I'm not going to be here 25 years from now. I'm probably going to be dead. So it's not time to focus on reducing the federal debt. Let these Gen Z assholes deal with the problem later. And here is the last bit of macro news, and perhaps a sign of more tensions to come between the US and China. Perhaps that the trade war is not over yet just because we have a new administration. Matter of fact, our relationship with China is worsening, and you're seeing the back and forth here with the US trying to punish Chinese firms via the SEC, and then China is responding with more nationalism and sentiment of boycotts against American brands. Case in point, what happened to Nike stock today. But rest assured, Uncle Joe's saying that China won't be the world's most powerful country on his watch. China's never going to defeat the US. We asked him for insurance, because I don't take anybody's word for it. I want insurance. So let's ask Uncle Joe how. How is he going to prevent China from defeating the US? How are you going to get it done, Mr. President?
So the best way to get something done, if it holds near and dear to you that you like to be able to, anyway.
Moving on to sentiment news, and here's what's going on with Chinese stocks. They're not doing so hot so. US-listed Chinese stocks fall into bear market. Technology heavy gauge that includes Alibaba, JD, and electric car maker NIO tumbles 6.4%, because we have these rumors that the SEC will start delisting Chinese companies. Those who has any military ties with the Chinese Communist Party or any ties with what's going on with China's treatment of Uyghurs. I know, but NIO is the future, bro. Even though it was trading at $100 billion and the company barely sells a car, shifting to the tulip mania. Where are my crypto maniacs? Be careful, boys, because they're coming for you. You're next. I'm smelling it. I'm already smelling the massacre. Bitcoin could be next domino to fall as investors rush to book profit, says technical analyst. Okay, and here we have Ray Dalio. Legendary investor Ray Dalio says it is very likely the US will outlaw Bitcoin. You already received the warning from Papa Jerome, who is giving you an advance notice before he starts crushing Bitcoin. And what excuse are they going to use to crash Bitcoin? Climate change. Bitcoin mining now consumes electricity on par with the country of Finland and almost as much as the entire US government. By the way, we got our viewership from Finland increasing rapidly. So if you are from Finland, let us know in the comments. Anyway, back to the article, tweet, whatever. This spiraling resource consumption indicates a basic weakness in the technology that supports Bitcoin. Have you noticed that the culties, whether we're talking about Tesla culties or Bitcoin culties or any green culties, the EV culties, doesn't matter what they are, the Archmaniacs culties, they all claim that they invest in the future, bro, and the old world is over, and it is a new, innovative, disruptive world. We think green. We love EVs to save the planet, to save the environment. Yet pretty much everything they support actually ends up harming the environment more than helping it. Case in point, all the pollution from the EV mania. Every EV maker is exploiting the resources, nickel, cobalt, lithium. And we know that mining for all of these resources consumes a ton of water and reduces an insane amount of pollution and waste. Some would argue even worse than the situation going on with crude oil. And what about the SPAC mania? The SEC is coming for that too. The US SEC has started an inquiry into the SPAC frenzy, seeking information on how underwriters are managing the risk involved. Reuters reported. So are they going to take Chamath Predatory to jail for what he's done? And here's more from the SEC. All of a sudden, they're waking up from the coma they've been on for the last 5 years. SEC investigating SoftBank, aka the devil. And they are investigating the gamma squeeze that happened last summer. We saw the Nasdaq rallying impulsively before crashing in September. Of course, if you remember, we covered all of this in this channel. The devil managed to manipulate the market via a gamma squeeze by buying an insane amount of call options. And they ended up losing billions and billions of dollars. And what about the meme stock mania? They're back. And they got their stimmy checks with them. Meme stocks were back in business as investors bought up shares of GameStop, boosting other Reddit favorite stocks along with it. and GameStop closed with gains over 50% today alone. This is one wild ride, and I do doubt that it is just a retail frenzy. As you know, there are very sophisticated games being played in the stock by rival hedge funds. The retail participation is just the sideshow. And what about the IPO mania? No love for the IPO mania. What's going on here? Vizio slumps 9% in the NYSE debut 14 years after the company took the TV market by storm. What's going on here? What, Vizio is not the future, bro? TVs are not the future, bro? So we know that Vizio did not get any love from the retail crowd and STEMI investors. So what are STEMI investors waiting for? Perhaps they're waiting for something new. What's that? Cathie Wood. Tesla witch Cathie Wood has a new project on her hand because she has a new space ETF that could hit the market starting next week. Of course, the maniacs will chase the space ETF because it is the future, bro. And of course, this ETF includes the good, names like LMT, Lockheed Martin, but it also includes the bad and the ugly, like Virgin Galactic, for example. But that doesn't matter. What matters is that it is the new hot thing being marketed to them. We're talking about the zombies from one of their cult leaders. All of what she's doing is she's packaging new garbage for you. These names can be traded individually. They're already in the market. You don't need to buy an ETF with the good, bad, and ugly just because it is marketed by Cathie Wood. Yet don't ever underestimate the power of cult leaders and their zombie followers. For example, here is a cultie tweeting. And of course, the culties are getting smacked very hard in the face right now because Tesla dropped about 40% from the highs. ARK Invest is down big. All of their mania names are down significantly from the highs, but they are still in denial, and they will continue to do what they're doing over and over and over again until what? Until they lose all of their money. That's how the story will end. The people clowning us for buying Tesla now are the same ones that were clowning us buying at $250 pre-split. Y'all are clowns. We'll be sitting down when us Tesla holders are getting pretty with the stock at 2,000 in a couple of years. We know what we own. We have done the research. Which part of your research missed the fact that the company is trading at $800 billion? Meanwhile, it barely produces any profit at all. It doesn't make money whatsoever from selling cars. Oh, but the robo-taxis, bro. Yeah, where are they? Where are the robo-taxis? And make sure, do me a favor. You want to help me out? Make sure you bookmark all of these tweets and statements from these donkeys, specifically the so-called quote-unquote influencers. The donkeys over at TikTok, YouTube, Twitter, doesn't matter. Do me a favor and bookmark all of these statements. Not because we want to rub them in their faces later on, maybe a little bit of that, but not too much, but because for educational purposes, we want to produce a documentary about sentiment during the heat of the bubble and the aftermath. You know, if you go ahead and research the sentiment in 99 in the dot-com bubble, you're not going to have any good resources to look at because it's not well documented. And our goal here is to document the mania for future generations to learn from. So do me a favor and bookmark these statements from these donkeys because it's already not working for them. The souffle is melting as we speak right now. Moving on to corporate-specific news, starting Porsche, not the souffle, Porsche. You can now subscribe to a Porsche Taycan for as little as $2,500 a month. Or you can lease it. Isn't that the same thing? Or it costs you $1,500 a month if you want to lease it, but it costs you $2,500 a month if you want to subscribe to it. And if you want to buy it as an NFT, it will cost you $10,000 a month. You know, the digital version. And what about Merck? Merck is developing another COVID pill. We talked about Pfizer's, and now we have a new pill coming out from Merck. Do they come in flavors? Moving on to the last bit of corporate news from the flying coffin. Boeing's defense unit dealt setback by the Pentagon. And of course, they're talking about Boeing losing the missile defense program to Lockheed Martin. The Pentagon chose Lockheed Martin over the flying coffin. Moving on to the heat map analysis. Let's see what happened today. It is a freak show. There is no specific theme whatsoever. The market dumps everything together and then pushes everything together almost when it's confused. The indecision before the decision. But the clear theme from today is the inflationary trade. Financials outperforming, industrials outperforming, materials outperforming, and the only exception here, the underperformance under the inflationary trade coming from energy and copper. Energy dropping down due to the rise in the US dollar. Likewise, copper dropping down also due to the rise of the US dollar. But if my outlook is correct, the dollar will reverse lower. We will look at the chart of the dollar in just a little bit. What about the deflationary trade? Tech, high momentum, what's going on here? We saw some rebounds, but mixed picture. For example, Tesla up, Apple up, Snowflake, DoorDash. Certain names managed to close in the green. But you also have losses and muted activities overall. Names like Square, Shopify, Trade Desk, the software names, Netflix, closing severely in the red. And we have certain individual stocks reacting to certain news. We have Alibaba being punished due to the tension between the US and China. And of course, I issued a tweet when the whole Jack Ma saga started. I told you, do not buy the dip in Alibaba because we don't know how this movie will end. China wants to break up Alibaba, and US regulators, the sentiment against Chinese companies is getting more and more hawkish. You see, Alibaba made that U-turn back all the way from the massive drop right after the Jack Ma news. We have Nike dropping over 3% today because they issued a statement criticizing China. They're not really criticizing. They're just saying that we're not importing any cotton or using any factories in the Xinjiang region where Uyghurs are being housed in what is called concentration camps. And that was enough to trigger calls for boycotts against Nike and other American and European brands. And what about the themes for the market? Let's see what's going on here. Starting with the reopening trade. We talked about the weakness in the reopening trade and the fluctuation based on the news regarding the virus and reopening. Today, we saw a rebound in these names. So we know that the market pumped everything higher, almost everything with very few exceptions, but we want to see the level of outperformance to confirm whether these moves are for real or not. The move in the reopening names today was very strong, indicating that this trades remains hot and perhaps has longer to go. But I remain bearish that the elevated valuations in these names will make them susceptible for massive, sharp corrections depending on the flow of news. Even the slightest bit of bad news regarding reopening will hurt these names. But my main theory is that we will see sell the news phenomena, meaning when we actually reopen the economy, these names could start trading lower. Now, what about the inflationary trade? Clear outperformance. We're seeing gains of more than 2% for American Express, Boeing, Kroger, Westrock, UPS, Hubble, Alcoa, Martin Marietta. That tells you that the momentum is still strong in these inflationary names. For example, here is a chart from Hubble, one of my favorite names, and I am waiting for a dip to buy. But the momentum is so strong that they are buying the dips aggressively. The name dropped about 8% from the highs and was bought right away. And I do expect this behavior to continue and go on because the macro and monetary environment is supporting for the inflationary trade. Now, what about the deflationary trade? Let's see what's going on here. You see the difference? Yes, certain names managed to close in the green, but notable underperformance. So the market is kind of telling you here which side it is still favoring, even within this period of indecision. Moving on to the charts analysis, starting with the SPY 30 minutes chart. I am using the 30 to show you how the chart reacted at the 386 support line and closing the gap that you see here on the chart. The SPY went down all the way, closing the gap, rebounding higher, rechecking 386 for support, and then continuing to ride higher all the way till the end of the day. Is there anything not to like from the move today, at least from a technical perspective? Because number one, you closed the gap and you rebounded higher. That's point number one. You get brownie points for that one. Number two, rechecking for 386 as support and bouncing higher. That's brownie point number two. Yes, it didn't manage to go all the way to recapture 391 for support, but you can't be mad at two positive technical reactions. Zooming out to the daily chart of the continuous contract, what do we see here? Going all the way to the trend line, rechecking for support and closing at the highs of the day. Very positive closing, indicating that the S&P 500 could go all the way to challenge 3,960 once again. And if you are paying attention to the details, you know that the inflationary trade is still in favor. Financials, industrials, materials, even energy will continue to rebound higher. The dips will be bought in these names, and that will support the S&P 500 to rise higher despite any underperformance from the Nasdaq, assuming that it is not very severe or contagious. That doesn't mean that the S&P 500 in the long-term picture is out of the wood. That's not what we're saying. What we are saying is that the action from today's activities, technically speaking, is bullish, signaling that the S&P 500 will give it another shot at breaking above 3,960. Whether it's going to be successful or not, that's a different story. Moving on to the Qs, 15 minutes chart. We know that the center of gravity is 313. It continued to pull the chart down when it was trading above it. And now it is doing the opposite. It is acting in favor of the Nasdaq going higher. Remember, it is the center of gravity. And Mrs. 313 is very possessive. It doesn't matter. Even if she's mad at the Qs, she still wants him back. And I issued this tweet in the morning telling you that 308.5 is the support for the Qs. It didn't look good in the morning when I issued this tweet, so I gave you the next number, 303.60. Yet the Qs managed to win the battle of 308.5, recheck it for support, and then closing at the highs of the day. From an intraday activity, this close is positive, meaning that we should be able to climb all the way to 313 and knock at the door again. Whether the door will be open or not, that's a different story. And watch out if the Qs gaps above 313 once again. That's a no-no. You don't do that. Moving on to the daily chart, continuous contract of the Nasdaq. What do we see here? Again, keeping the hope alive, shall we say, of the reverse head and shoulder formation to play out. And the ultimatum is the level of 12,766. Today's closing was 12,792. So we are still above the line in the sand. But closing below that will be a signal to short the Qs once again. My favorite way to do that is via buying calls on the SQQs. Moving on to the IWM, 15 minutes perspective. We made this bottoming formation, the ABC, and we managed to bounce higher, but we closed short of the very important line of 218. Is that positive? Is that negative? The intraday activities are positive, and perhaps it is a reaction to the massive pop in GameStop stock. We talked about the weighting of GameStop in the IWM. It is becoming a meme ETF. And what about the RUT, the bigger index of the IWM? We talked yesterday about the series of higher highs and higher lows. And as long as this is intact, then the Russell 2000 is not bearish yet. But we know that there is a massive sign of danger outside the Russell 2000 property because it is filled up with names, meme names and the likes, that are highly overvalued, way out of whack, and they will face Judgment Day sooner or later. So it is just playing musical chairs here with the IWM. You can extend the music all you want, but the effect of that is that when the music stops, the drop will be severe. And perhaps we're already there, and we saw a top in the IWM. But we're not going to call it unless we see a break in the pattern. And by the way, I showed you the chart yesterday, and I pointed out the support on the Russell 2000's chart as the equivalent of the reading of 127.20 in the IWM. That was an error, and thank you for the viewer who pointed that out. 127.20, that would be a wild drop. But we're talking about 207.20. And you saw that the IWM went very close to that point, not above it by a lot, and then bouncing higher. And by the way, we saw the area between 207 and 208 acting as support for the IWM, not once, not twice, but this is the third time where we see the IWM bouncing higher from that area. Moving on to the Dixie. What do we have here? The Dixie surging higher once again. The sky's the limit. Or is it? Because we have a resistance line here that will coincide with the levels of around 93. That should be a good place to stop here for the dollar index. Whether it is a pause, We're going to rally later. That remains to be seen. But the long-term trajectory for the US dollar, at least given the facts that we have right now, is lower, not higher. But we are seeing a rush to buy the US dollar as a safe haven due to the collapse of bond prices. But as I said in yesterday's video, I'm not trusting the move higher from both the TLT and the Dixie. The TLT went down today, the Dixie continues to rally, but I am still skeptical of the move in the dollar index because here is gold, and if the rally in the US dollar was legitimate, then we should be seeing gold reversing lower severely. That didn't happen. Gold still grinding against this Fibonacci level of about 1740. My number is 1760. Doesn't matter. You do have resistance in that zone. And when the chart behaves in the same manner of consolidating just below the resistance line, then the assumption is that it will be able to break above that level and trade higher. We saw that happen with the dollar index with the level of 92, and now you're seeing the big breakout above 92. Because the energy is released higher. Likewise, we're gathering energy here for gold just below 1740, 1750. Those little differences don't matter. And the assumption is that the energy will be released higher. And if the energy in gold is going to be released higher, then are we assuming that the US dollar will trade lower? This is exactly what the move in gold is telling us right now. Because maybe you're saying, oh, but gold is holding steady due to the decline in Treasury yields. Well, we saw Treasury yields going higher today, and gold held steady anyways. Because gold is calling the bluff in the US dollar. At least this is how I read it right now. Now, what about Bitcoin? What's going on here? Bitcoin still holding steady. The bear flag is playing out to the downside, but we are not breaking the series of higher highs and higher lows until and unless we do that, the chart remains bullish technically, but the warning signals are happening day by day. Whether it is the negative statements from Fed Chairman Jerome Powell, or the ban from India, or today warnings from Ray Dalio that the US will ban trading cryptos, my hunch is they're coming for Bitcoin. They're planning something here. So watch out and be careful. Moving on to the 10-year Treasury yield. What do we see here from a 2-hour chart? We have a series of higher highs and higher lows, and I identified the level of 1.622 basis points as good support. And you are seeing the chart looping around that number, not sure of what to do next, but we did not break the series of higher highs and higher lows. For that, the chart remains bullish. Until we do so, then the chart turns negative. And even if it does, we have 1.5 as very solid support for a bounce and a rebound higher. What about the TLT? Treasury bonds prices. We talked about 139 as possible resistance. Today we stopped at about 138.66, and then came the reversal lower in the TLT. So we came close enough to 139 and we turned lower. Is this it? The reversal in the TLT, and we will see yields surging higher, and now we have the inflationary trade going higher, and technology, the Nasdaq, diving lower. We don't have a confirmation yet, we just have a rejection from a resistance zone. If we dive lower tomorrow, then we have a confirmation. So we are watching out for a confirmation here in the TLT, and that will come hand in hand with yields rising higher, financial stocks rising higher. You get the picture. What about the VIX? The VIX traded higher today. It didn't manage to go all the way to 25, but then we saw the indices recovering from the lows of the day and closing at the highs of the day, and the VIX reversed lower and closed at the lows of the day, below the level of 20. The big question to ask here is the following. Everybody's assuming that if the VIX closes below 20 from a weekly perspective, then the trend is negative for the VIX, and that means that the market is about to have a fantastic rally higher. Ask yourself a question. Is this a rational conclusion with all of the concerns regarding inflation, overvaluation, taxes, the tensions with China? Are we really going to have this fantastic rally coming up? And if the VIX wanted to go lower, why hasn't it done that earlier? Last year, during the massive rally since November, you would think the VIX will drop under 20. The VIX never got under 20 because it has another trick in its sleeve. And that trick is shooting up higher again. Moving on to Apple, 15 minutes chart. The ultimatum here is the level of 120. You gotta close above 120. Better yet, you gotta close the week above 125. But we will be generous here and say Apple has to close has to close. There's no other choice here above 120. Otherwise, we have lower prices, not just in Apple, but in the NASDAQ. We have 117 as the next support. If that doesn't work, then we have 113 to look forward to. And what about Tesla? Tesla rebounding higher today. It managed to dip slightly in the next Fibonacci level, which is bearish, but then managed to close at the highs of the day, and it remains in the same Fibonacci level it closed at yesterday. Is this bullish? Is it bearish? What it tells me is the following, that the chart is being pulled down, but it doesn't want to go down. It wants to cling on any thread of hope that could push it higher. New price target from Cathie Wood, new promises, false promises, doesn't matter, from Reverend Elon Musk. You still have dip buyers in this name, and the name doesn't want to give up easily. But the difference here and then, talking about before 2021, the center of gravity for Tesla was always higher because rates, the trajectory was downward, and EV raw materials prices were a lot cheaper, and the competition was pretty much non-existent. So the gravity was higher, to the moon, bro, and the stock indeed went to the moon. Now these dynamics are shifting with higher yields, higher input prices, and more competition. The center of gravity turns south, and now you have a zombie stock that you have to artificially stimulate every now and then with new price targets from Cathie Wood, new hopes, new false promises. Doesn't matter. Elon Musk announcing something and causing the stock to spike higher. But at the end of the day, the tides turned against Tesla. And what we're looking for here is, I already got my confirmation closing the gap between the two hammers, the green hammer and the red hammer, and then closing below that. That was my confirmation to buy Tesla puts. And I am looking for Tesla to close on weekly basis below 625. That will be a confirmation that lower prices are about to come. However, closing above 625 will keep the hope alive for the bulls. Matter of fact, closing above 679 will be the ultimate confirmation for the bulls that Tesla has higher prices to visit before it turns lower. So two numbers to watch here. 625, closing below, not good. Closing above, all right, we move on to the next chapter of the battle. Closing above 679, we have higher prices to go. And here is a bonus chart for today's episode. For Alibaba, here is a weekly chart, and we saw the massive drop after the news regarding the disappearance of Jack Ma. And the dip was bought right away, pushing the stock all the way to the resistance of the Fibonacci retracement level of about 275 before reversing lower, going all the way back. We do have confirmations from both the Fibonacci and the MACD indicator that there are lower prices to come for Alibaba. And my number here is 180. 180 will be an extreme correction, and you should see Alibaba bouncing higher and holding support. But for now, we have a confirmation from both the Fibonacci and the MACD that we have a lower leg to visit. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have important data regarding inflation from personal income, consumer spending, core inflation, and consumer sentiment index. This will be the final reading for March. Why is tomorrow important? Because we are still dictated by the tug of war between good news and bad news. Good news meaning closer to the reopening, but that comes with a caveat, and that is the rise in inflation. Then we have bad news. Bad news mean prolonged lockdowns and later reopening, but it also means tampering inflation expectations. That is good for the Qs and for the market in general, because it tells the market that low interest rates and the cocaine operation will be here for longer than what the bond market is calling for right now. And therefore, tomorrow will be very important because we will receive data regarding inflation. If the data is cooked and showing low inflation, even though all the facts are pointing to higher inflation, the market might celebrate that. But if the data comes out honest and transparent, showing higher inflation, then we should see yields bouncing higher, TLT going lower, the inflationary trade catching a bid, financials up, industrials up, materials up, meanwhile, technology and momentum down. The other dynamic is the dollar index. The dollar index is dictating the movement in both energy and copper stocks. Now, if you have the dollar declining and retreating tomorrow, along with a spike in yields, then you know that energy and copper prices will have double tailwinds to rise higher, meaning Freeport-McMoRan, ExxonMobil, these are two names we want to watch tomorrow. Anyways, that's all I got for you tonight, and I will talk to you again soon. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.